Picture this. You purchase an investment property for $100,000 and you decide that you're going to rent it out every year. For the sake of ease, let's say that you're renting it out for $50,000 per year. If I ask you what your annual return is on your investment, well, since you paid $100,000 and you're renting it out for $50,000 every year, then your return is 50%. Another way to calculate this would be to say $50,000 divided by $100,000 times 100 is going to give you 50%. So let's take that exact concept now and apply it to calculating the current yield on a bond. This is the exact same question and the exact same concept. When you're asked to calculate the current yield on a bond, you're being asked that if you were to calculate how much you're expecting to get in a year in terms of return based on what you paid, then it's the same thing that we just discussed. So let's read 18 and answer it together. A semi-annual bond with a 5% coupon is currently trading at 94. It has 4 years to maturity. Its current yield is. All right, so just like when we were talking about the investment property, all that we needed to know to figure out what your yield in a year was how much you paid for it and how much you were getting annually. And so that's what we need to figure out here based on this wording. So that's what they're testing. So it's got extra information here. The fact that it's a semi-annual bond doesn't matter. That would just mean that the interest payments are made every 6 months. But the fact that it's got a 5% coupon rate is what matters, because that means that it is paying 5% of its face value for every year. And the fact that it's currently trading at 94 is important because that's its price, and that's how much you're going to pay for it. And it's meaning that it's trading at 94% of its face value of $100. So in this case, you're paying $94 if you want to purchase this bond. So since the coupon is 5%, its face value is 100. Then if you're earning 5% annually, then you're getting $5 annually on this bond. And since it's currently trading at this discount of 94, then you're actually only paying $94 for it. So now we know that you've paid $94 and you're earning $5 annually. So all we need to do is say 5 divided by what you paid for it, 94, times 100, is going to give you your answer, which is 5.32%, okay? So again, that was the amount in dollars, $5 divided by how much you paid for it, $94 times 100 is going to give you 5.32%. Now, there is an easier way to do this in which you don't need a calculator, which is so fascinating about this particular question. So you know that if you had actually paid the full $100 for your bond, then obviously your return would have been exactly 5%, because $5 out of 100 would have been 5%. So naturally, if you paid less for the bond to start, but you're still making the 5% coupon every year of the face value, then you are obviously going to get a value higher than 5%, right? Because now you're taking your annual amount of $5 and dividing it by a lower number than 100, which means that you are getting a higher return than 5%. And so since there is only one answer here that has an answer that's higher than 5%, then you can really, through the process of elimination, just figure out that the answer must be 5.32% and all of the other ones must be incorrect. So it definitely couldn't be 2.5% because that would be a lower number. It can't be 5% because it's not trading at $100, right? Like $5 out of 100 would have been 5%, but you only paid $94. We know that C does have to be the correct answer, and we've gone over 2 ways to figure that out. You could either intuit that obviously if you're getting $5 because the face value of this bond is $100, so if you're getting $5 every year, then you know that your return has to be greater than 5%. But you could also figure this out by going through the whole process and calculating it, in which case you would just take your $5 divided by what you paid, $94 times 100. And then finally, D asks if you have insufficient information. Well, that's not true because, like we said, just like if you were going to figure out your yield on the investment property, you have sufficient information as long as you know how much you paid and you know how much you are getting every year. So thanks so much, and I hope that this helped you understand the current yield of a bond and how to calculate that.